Hey everyone, welcome back to my YouTube channel Insurance and USA. It's me Takeyu again. So today we are gonna talk about a state-based insurance regulatory system in US. Historically, the insurance industry in the United States was regulated almost exclusively by individual state governments. The first state commissioner of insurance was appointed in New Hampshire in 1851, and the state-based insurance regulatory system grew as quickly as the insurance industry itself. Prior to this period, insurance was primarily regulated by corporate charter, state statutory law, and de facto regulation by the courts in judicial decisions. Under the state-based insurance regulation system, each state operates independently to regulate their own insurance markets, typically through a state department of insurance or division of insurance. Stretching back as far as the Paul, Virginia case in 1869, challenges to the state-based insurance regulatory system have risen from various groups, both within and without the insurance industry. The state regulatory system has been described as cumbersome, redundant, confusing, and costly. The United States Supreme Court found in 1944 case of United States Southeastern Underwriters Association that the business of insurance was subject to federal regulation under the Commerce Clause of the U.S. Constitution. The United States Congress, however, responded almost immediately with the McCarran-Ferguson Act in 1945. The McCarran-Ferguson Act specifically provides that the regulation of the business of insurance by the state governments is in the public interest. Further, the Act states that no federal law should be construed to invalidate, impair, or supersede any law enacted by any state government for the purpose of regulating the business of insurance, unless the federal law specifically relates to the business of insurance. A wave of insurance company insolvencies in the 1980s sparked a renewed interest in federal insurance regulation, including new legislation for a dual state and federal system of insurance solvency regulation. In response, the National Association of Insurance Commissioners adopted several model reforms for state insurance regulations, including risk-based capital requirements, financial regulation, accreditation standards, and an initiative to codify accounting principles. As more and more states enacted versions of these model reforms into the law, the pressure for federal reform of insurance regulation waned. However, there are still significant differences between states in their system of insurance regulation, and the cost of compliance with those systems is ultimately borne by insureds in the form of higher premiums. McKinsey and Company estimated in 2009 that the U.S. insurance industry incurs about $13 billion annually in unnecessary regulatory costs under the state-based regulatory system. The NAIC acts as a forum for the creation of model laws and regulations. Each state decides whether to pass each model law or regulation, and each state may make changes in the enactment process, but the models are widely, albeit somewhat irregularly adopted. The NIC also acts at the national level to advance laws and policies supported by state insurance regulators. NIC model acts and regulations provide some degree of uniformity between states, but these models do not have the force of law and have no effect unless they are adopted by a state. They are, however, used as guides by most states, and some states adopt them with little or no change. There is a long-running debate within and among states over the importance of government regulation of insurance, which is noticeable in different titles of their state insurance regulatory agencies. So my video is just ended up here. Hope you like and enjoyed this video. So if you like this video, just give this video a big thumbs up, like, share, and subscribe to my YouTube channel. We'll meet you soon in another video with some more informative collection. Till then, take care. See ya.